You wait hours for your setup. The price finally pushes past resistance, offering a clear breakout. You buy in, anticipating a rally, but almost immediately the price crashes. Your stop loss is triggered before the trade even had a chance to breathe. This sequence happens to traders constantly. It occurs because trading purely on short-term charts leaves you exposed to heavy market noise. You are reacting to small, chaotic movements while missing the actual mechanics driving the price. To stop buying into fake breakouts, we need a method that filters out that noise. This is candle range theory. It is a systematic way to track where institutional money is stepping in. By drawing precise boundaries based on a single higher time frame candlestick, you can identify exactly when the market is setting a trap. This allows you to position yourself for the reversal, rather than becoming the victim of it. Step 1 requires stepping back. Before you look for an entry, you have to zoom out to a higher time frame to identify the overarching market trend. Draw lines at the exact tip of this daily candlestick's highest wick, the candle range high, and lowest wick, the candle range low. Inside, you'll find the erratic price action of lower timeframe candles, all contained within these boundaries we just mapped. To correctly pair your charts, you must follow a struct timeframe cheat sheet. If your overarching trend is monthly, your entry timeframe is daily. Daily pairs with the 1-hour chart. 4-hour goes to 15-minute. 1-hour links to 5-minute, and 15-minute requires a 3-minute entry chart. Sticking to these specific pairings prevents you from getting caught in random fluctuations that have no bearing on the larger trend. Step 2 is identifying the trap phase. This is the moment when the price breaks out past your established high or low boundary, but quickly loses its momentum. Here, a candle drops below our bottom boundary, faking a sell-off. Instead, price retracts, leaving a long wick, the manipulation candle. Institutions trigger retail stop losses here to gather liquidity. After it closes, draw new lines at the extreme high and low of this wick. What initially looked like a failed breakdown is actually the physical footprint of smart money. They have cleared the board and are preparing to push the price in the opposite direction. Now that the trap is set, step 3 is execution. Switch immediately to your lower time frame, using the exact pairing from the cheat sheet we covered earlier. On this 5-minute chart, your trigger occurs when price forcefully pushes past the manipulation candle's top boundary. Don't enter on that initial break. Wait for price to drop, touch the broken line, and retest it as support. That bounce is your buy signal. To protect your capital, place your stop loss securely just below the most recent swing low that formed right before the retest happened. Demanding that lower time frame retest acts as a mandatory safety filter. It ensures you have confirmed momentum and protects you from falling into a secondary institutional trap. The final step is knowing when to exit. Instead of guessing, you must set math-backed profit targets that align entirely with the overarching market structure. This split screen compares two scenarios. Top, trading with the trend. With overarching momentum, it's safe to set your profit target at the higher time frame candle's opposite extreme boundary. Bottom, counter-trend rule. Against market structure, aim only for the previous candle's closing price, never the wick. If you aim for the extreme high during a counter-trend move, the market will frequently exhaust its momentum and reverse downward before hitting your target. Adapting your targets to respect the larger market structure turns a solid entry tactic into a mathematical, repeatable system. The process is strict but clear. Map the daily range, wait for the institutional trap to form the manipulation candle, enter only on the lower timeframe retest, and scale your target based on the overarching trend. Open your charts today. Pick any daily timeframe asset and locate one manipulation candle from the past week. Draw the boundaries and drop to the 1-hour chart to trace the retest. Following these specific rules takes patience, but waiting for the manipulation to happen ensures you are trading alongside institutional capital, rather than providing the liquidity for it.